Hello, credit union community. I am with Dan Daggett. He was a former credit union CEO, and now he is the Chief Strategy Officer at Credit Unions First, a QSO obsessed with boosting profitability in your insurance products. And today, Dan, you are going to show us the Navigator platform and kind of show us how credit unions can proactively manage their loss ratios with LSI products. Am I right?
Correct. But not only LSI, we've got some other products there to show you as well.
Awesome. So Dan, please, I've been called a lot of things in my life, but an insurance expert is not one of them. Can you walk us through the product and show us what's happening?
Sure. So in the world of collateral protection insurance, there are two primary product sets that are out there. One's known as forced placed, where an insurance policy is forced onto a credit union member's loan when they let their insurance lapse. The other is known as blanket lender single interest, which is the product we have. We believe it's the product that aligns with the credit unions of people helping people. The blanket means the entire portfolio from their inception are covered once they start to adopt our program.
Got it.
The cool thing about our program is we actually split up the program into two separate categories, one being a prepaid deductible. Credit union sets a high deductible that they're comfortable with and we manage to. And the other is severity losses, so any losses above and beyond that deductible amount. And we put all of that data, both their policy count into the Navigator platform as well as their losses, their claims, and we track that and manage it to a preset loss ratio that the credit union determines, whether that be 40%, 50%, 60%. The credit union is in control.
Okay, sweet, Dan. Please walk us through the platform and show us what you got.
So as you can see here, this is our Navigator platform, and we're looking at all loan types. And with all loan types, you can see here, we're looking at direct new auto, direct used auto, indirect new, indirect used. A credit union might be doing boat loans, so they're doing motorcycle loans. All those product sets can be included in here, but just for a standpoint of us demonstrating the platform, we're just looking at this with a direct and an indirect auto portfolio. As you can see, we're looking at this over a 12-month period, looking at the gross prepaid deductible, what they're funding into their general ledger, what they're earning, because there is an earning component to our program, what they have in claims and loan expenses for the collections of that, what they've put out there, the prepaid loss ratio, and also the severity loss ratio, which is really unique.
Speaking of unique stuff, Dan, what happens today is most credit unions, they cannot look at this stuff proactively, correct?
Correct.
They cannot look at the performance of their insurance programs, and then what ends up happening is at the end of the year, they confront their losses or gains, but there was nothing for them to do throughout the year to make those adjustments to be proactive. Is that correct?
Correct. And part of the reason we've done this is on a daily basis, they can put their new loan count in, we can put their claims data in, and we're actually working on some interfaces now to automate that process so the credit union doesn't have to go in and manually do that, and that's probably only 2 or 3 months out to be completed. But, you'd mentioned at the end of the years when they have to confront their losses or their gains, most credit unions aren't in a position where they can partner with an insurance provider for gains, which is what the other unique part of this, is that on these prepaid deductible dollars, whatever is not paid out in claims, the credit union can then take back as revenue. God knows all the credit unions are looking for revenue with the shrinking net margins that exist.
So really what this is doing then, Dan, is this is really making your insurance program more profitable. Is essentially what it's coming down to.
Exactly.
And what are you seeing in terms of losses or gains? How much money do you think credit unions are really leaving on the table by not being proactive with this stuff?
Well, that's an easy one to say. So in the insurance world, whether the insurance product is a service contract, it's an LSI, it's a forced place program, all insurance companies try to manage their losses to a 50% loss ratio. So in this situation, let's say a credit union is just using a traditional LSI program and their premiums are $1 million a year. Well, they're leaving $500,000 on the table. Just the quick math, because that organization is going to manage their loss ratio to a 50% level. So it's really easy to do that math.
What does this allow you to manage that loss ratio to, Dan? Like, what are you seeing in terms of outcomes with this?
Certainly. Our current credit union, Amico, we're managing theirs to a 50% loss ratio, and it's been very, very effective. The one nice thing that you can see is as these lines of graphs go up, And we're also proactive with the credit union management, that we can set triggers in the Navigator platform that, let's say, when a loss ratio has been managed at 25%, but they've had a spike in claims and all of a sudden it goes to 40 or 45%, the system will email whoever they want in the C-suite to let them know, hey, your loss ratio is going up. So they don't have to necessarily look at this every day. The system's set up to give them those notifications. And when they do that, we can be proactive in saying, okay, you're at 50% or you're over. Let's say their per loan premium is at $75, with half going to severity claims and half going to a prepaid deductible, and their loss ratio climbs up to 55%. We can then go in and say, okay, we need to make an adjustment from that 75 up to 82 for this coming month. And now all of a sudden their loss ratio that following month drops to 45% because we were proactive in making that adjustment in the month that it occurred. We're not waiting 12 months down the road for the carrier to come in and say, hey, horrible news, your loss ratio hit 75%. Your premium's going up by $80 this year. We can proactively do that and manage it and look at where some of those losses are. One of the nice things when I mentioned that integration that'll be coming down the road is right now the granularity here is by loan type. And I should also mention, we have some other views here too. So on the fly, we can look at losses in real time, dollars on a month-to-month basis. But we'll be adding in here dealerships. So one of the interesting things is with the carrier and the provider that we have, we'll be able to get that real granularity at a dealership level. So if a credit union is working, has an indirect program, and we can see that there are losses coming in, we can get down and say, hey, ABC dealership in, Danforth, Maine is accounting for 20% of our losses. All of a sudden, that gives us the opportunity to go in and say, hey, what's going on with this dealership? Are they letting folks know, hey, you don't have to carry insurance with this credit union? No, that's not the case. They do. And if there's a loss, these are the steps we need to take.
Wow.
So we can be proactive on the claims and losses side as well. And that's just some unique characters or characteristics of our program that traditionally don't exist.
If you want to learn more about Credit Unions First, their Navigator platform, or their Blanket LSI program, head over to creditunionsfirst.org. That's creditunionsfirst.org. We will see you next time. Take care. Bye-bye.